The skill set you need to manage private equity is very different than the skill set you need to manage public equities, because if you get into it and you've made a mistake, your exit isn't to exit at a slight discount and get out of your stock position. You have to work your way out of those things. In order to work your way out of it, you need to have a certain skill set. That skill set is, in many cases, more aligned with being a manager of the company itself than being the manager of a portfolio. So that means as an investor in private equity, you need to understand the underlying businesses and not manage a portfolio of transactions, but actually understand the specific asset. A woman from a French pension fund came in to see us the other day and said, you know, I look at your portfolio and you have significant concentration. And I said, well, that's what you want us to have, because what function we offer to you is the ability to actually manage these assets. If you want diversification, your job is diversify away from us through other asset classes. Well, the Canadian private equity scene is largely a mid-market scene at the fund level. And so generally deal size is much smaller than it is in the U.S. In addition, I always say the similarity between what we do and a large U.S. private equity fund is the similarity between a corner grocery store and Walmart. They're two completely different models and completely different businesses. The institutional market in Canada is also very different. The institutions in Canada have seen themselves as more active participants in the private equity scene than is the case in U.S. private equity, in U.S. institutional private equity markets, and therefore at the large size particularly, and even in some of the mid-sized transactions, as Andy will tell you, the Canadian institutional market is a very active participant in the marketplace here. So there's a lot of differences. In addition, the Canadian market is significantly natural resource based. So once you take out what are traditionally not LBOs, meaning oil and gas deals, timber deals, mining deals, there's heavy concentration in the banking sector here, so there aren't a lot of financial service transactions to do in Canada, and the healthcare system here is nationalized. So as a result, what creates most of the transactions in the U.S., which are healthcare, financial services, and many other things, are generally not available in Canada.
After the pension funds, and I would speculate, this is just a speculation, I haven't seen the data, but I would speculate that pension funds probably make up 2/3 of the LP base or the limited partner base of most private equity funds. After pension funds, there are a number of other participants, however. These are the likes of family offices investing the wealth of wealthy families, the likes of endowments, the university endowments, and a host of other participants. But I would assert that by far the largest investors in the asset class would be pension funds. And in Canada, that is particularly acute because of the funded model that we followed here amongst many of our pensions.
When I raised my first fund, there was me and one guy sitting in a room. And now we have 15 executives, of which 11 of them share in the equity in some form, some as much and maybe next time more than me, and some in small amounts in our firm. But it's very interesting because all of us are looking to be the guys who survive for the long term by transitioning to the next participants in the team. So that's, I think, an important point that he raised earlier. So we have 2 managing partners, 5 partners, 4 associates or vice presidents, and then some analysts. And that's how it works. And traditionally, what happens is that there are 5 or 6 different functions that a private equity individual has to do, and they generally have to be able to do all of them to succeed in this business. One of them is to find transactions. And that's not an easy thing for many extremely analytical people who aren't used to, networking in that sense. More important, though, than finding transactions is being able to pick the ones you want to work on and spend time on, and knowing which ones to spend your time on, which ones not to spend your time on. There's an additional function, which is the ability to analyze those transactions, to do model building, to do industry knowledge, and they differ substantially depending on the size of the transaction, but lots of work done during the due diligence process. The ability to finance the transaction is also a very important factor, because returns can only be achieved generally in the non-growth area, but in the value area of private equity, if you can create some level of leverage in those transactions. And the ability to exit. Knowing when to exit and how to exit is also an important factor. I mean, the topic you've asked me is just too big. I'll take up the whole time here. These guys need to talk as well on this topic. But every fund does it differently. Every fund originates differently. Every fund organizes those functions differently. But suffice to say that if you can't do all of those functions, eventually you don't become a partner in one of those funds, and eventually you don't have the ability to either do it on your own or gain a significant equity position in the fund. So people are constantly trying to ensure that happens. The ability to get your 15 people, or in Teacher's case 60, or in Andy's case a dozen, or whatever he has, to work together on all of those transactions. I even forgot the most important part of it, which is how to manage the transaction after you own it and how to build the business. That's probably more important than any of the other functions, and one that is creating a situation where more and more operating guys are moving into our business, and fewer financial people are surviving in our business with those skills alone. It's a very complicated question, and it's the secret sauce. It's Colonel Sanders' recipe.